Welcome to The Deep Dive, your go-to for cutting through the noise and really getting the core insights from the latest earnings calls and financial updates.
Yeah, we try to make sense of it all.
Exactly. Today, we're tackling Stellantis' first half 2025 preliminary financial information. This isn't just numbers. It's, a story about a global automaker hitting some unexpected bumps and making some tough calls, maybe laying groundwork for a comeback. It's a really interesting glimpse into, corporate life in a volatile market.
Absolutely. And it was pretty unusual, right? They released these preliminary figures early, held a specific call.
Yeah, why did they do that?
Well, because the initial results were frankly quite different from what analysts were expecting, especially on profit and cash flow.
Oh, okay.
So putting it out there early, even without formal guidance yet, it does show a certain commitment to transparency, even if the news isn't, all sunshine and roses.
Right. Better to get ahead of it.
Yeah.
So let's get straight to those H1 2025 numbers then. What did we see?
Okay, so net revenues landed at about $74.3 billion. Adjusted operating income, AOI. That came in around $540 million. But, and this is important, that figure excludes about $3.3 billion in net charges from their IFRS numbers.
Well, okay, $3.3 billion excluded. And the bottom line?
Well, that's where you see the impact. A net loss of approximately $2.3 billion, and that number includes those big, unusual items.
Oof. Oh, and cash flow. That's always key.
Yeah, industrial free cash flow saw an outflow. So cash going out of $3 billion.
$3 billion outflow, right.
So like you said earlier, the revenues and the volumes, they were kind of sort of in line with what the market thought. But it was really that profitability, the AOI, and especially that big negative cash flow number that clearly diverged from consensus.
So the early release makes sense then. They needed to explain that gap.
Exactly. It signals pretty clearly a challenging first half.
Okay, so we had the numbers. Revenue's okay-ish, but profit and cash flow way off expectations. Let's really dig into the why behind that AOI miss. What happened?
Well, they pointed to four main areas, really. First off, lower volumes than they'd hoped for. The European LCV market, like commercial vehicles, vans, that was sluggish.
Right.
And they also had a slower production ramp up for some new passenger cars they just launched.
Okay, so Europe was tough. What about North America?
Similar story in some ways. Fleet sales were still low compared to the overall market, even though retail, direct sales to consumers showed some improvement. And production over there also faced some downtime because of all the noise around potential tariffs before the actual policies became clear.
The tariff uncertainty hitting operations. Okay, so lower volumes, number one. What's two?
Higher industrial costs. Part of that is what's called fixed asset absorption. Basically, if you make fewer cars.
Your factory costs get spread over fewer units, making each one costlier.
Exactly. And they also flagged increased warranty costs playing a part.
Okay, costs up. What else?
Third was foreign exchange. FX had a pretty big negative impact, just under €1 billion compared to last year.
$1 billion from FX. Wow.
Oh.
What currencies?
Mostly the Turkish Lira, but also the euro strengthening against the US dollar and the Brazilian real. Those were the main drivers.
Okay. And number four?
Tariffs themselves. They booked a net impact of about $330 million in the first half just from tariffs.
Right. And is that in line with what they expected for the full year?
It actually is pretty consistent with their earlier estimates, which were around $1 to $1.5 billion for the whole year. But importantly, they said they expect a significantly larger hit from tariffs in the second half.
Okay, so the tariff pain is likely to get worse before it gets better.
Yeah.
Now back to that $3.3 billion in adjustments you mentioned, the ones excluded from AOI. That's a huge number. What's the story there?
Yeah, it really jumps out. It's crucial to break it down. Roughly $2 billion of it was tied to what management called decisive and tough decisions.
Sounds like cutting programs.
Pretty much. Decisions on product programs that just weren't making enough money. This included a big €700 million charge for their hydrogen fuel cell vehicle efforts.
So pulling the plug on hydrogen.
Seems like it, yeah. Plus other product cancellations, payments to suppliers related to those, and restructuring charges, mainly for reducing headcount in Europe.
So a major cleanup of underperforming projects.
You could call it that. It shows they're willing to make those hard calls, prune things that aren't working, even if it hurts in the short term. It signals a perhaps more ruthless focus on returns now.
That makes sense. What else was in that $3.3 billion?
Okay, then about $700 million came from non-cash impairments, think write-downs, mostly on certain Maserati vehicle platforms.
Reflecting slower sales for Maserati, I guess.
Unfortunately, yes. That reflects the current reality there. Then another $300 million or so was a net expense tied to changes in U.S. CAFE penalty rates. Those are the fuel economy rules.
Regulatory adjustments.
Yeah, it's complex accounting, but basically adjusting the books for expected fines or credits related to U.S. emissions rules. It shows how regulation keeps shifting.
Okay. Anything else major?
And finally, about $300 million was linked to expanding the Takata airbag recall in Europe, plus some smaller miscellaneous bits.
Got it. And you mentioned some of this was non-cash.
Right, that's key. Roughly half of that total $3.3 billion didn't involve actual cash going out the door in this period. Important for understanding the real cash impact.
Okay, which brings us back to that industrial free cash flow outflow of $3 billion. You're saying the low AOI didn't cover investments.
Pretty much, yeah. The profit they did make just wasn't enough to cover their ongoing spending on capital expenditures, factories, equipment, and their R&D.
So they're still investing heavily, even with the profit squeeze.
They have to, right, to stay competitive long term. But yeah, with lower profits, that investment came straight from their cash reserves this half.
What about inventory? Did cars pile up?
Interestingly, no, not really overall. Total vehicle inventory at the end of June was roughly flat compared to 6 months earlier.
How does that work if production was tricky?
Well, their own inventory, the OEM stock was up by about 60,000 units, but dealer inventories were down by a similar amount. So globally, it kind of balanced out.
Okay, interesting balance there. Now, management did try to spin a positive, highlighting sequential improvement from the second half of last year, right?
We did, yeah, compared to H2 2024.
But looking at a net loss, big cash outflow. I mean, does sequential improvement really cut it?
Yeah.
Convince me this isn't just, bumping along the bottom.
That's the million-dollar question, isn't it? And they were upfront. They said they're not happy with the current performance.
Okay, good.
But they do see it as progress on the trajectory. Sequentially, volumes and revenues were up, the AOI margin did improve, and that cash outflow, while still negative, was roughly cut in half compared to the previous 6 months.
Right, so the bleeding slowed, maybe.
That's their perspective. It's a foundation, they hope, for a much better second half. The big hurdle now is proving it's a real turn, not just a temporary stabilization before more trouble.
Makes sense. So how do they plan to actually make that turn happen? Let's get into the recovery strategy. What are the big levers they're pulling?
Product. That was a huge part of their story on the call.
Okay, what's new?
Well, they already launched 5 new B and C segment cars in Europe, think smaller, mid-size stuff. And they refreshed their Ram medium and heavy-duty pickups in North America. That helps fill some gaps.
And more coming.
Definitely. They talked about a significant ramp up of new B segment cars, 3 brand new Stella medium platform models in Europe.
And Jeep. Anything happening there?
Big news there, the return of the Jeep Cherokee to North America in the second half. That's been missing.
The Cherokee's back. Okay.
So all that new metal is expected to drive improvement. And they've promised to give actual financial guidance again on their July 29th call.
Right, the one with the new CEO, Antonio Pelosa. That'll be key.
Absolutely. Now, connecting this to market share, because analysts definitely push them on that.
Yeah, I bet.
In Europe, even with that sluggish LCV market where Stellantis has a massive 30% share, it's a big profit engine for them. Their share actually went up by 1.3 percentage points in H1 compared to H2 last year.
Really?
New products helped, they said, even though the ramp-up was slower than they wanted. And keep an eye out for the Fiat Grand Panda launch in September. That's a key B-segment car.
Okay. But Europe's competitive, right? And CO2 rules.
Fiercely competitive.
Yeah.
And yes, CO2 compliance is a constant challenge. They highlighted their BEV, battery electric vehicle penetration, rose to 13% in H1.
Are those EVs profitable?
They said their new affordable B-segment BEVs have good range and are profitable, though, typically less so than the traditional gasoline or diesel versions.
A pragmatic EV approach then. Now, what about Ram? That's huge for them, right?
Yeah.
And there were concerns about fleet share.
Critical brand. And yeah, fleet share was a sore spot. Big move there. They brought back Tim Kiskus to run the Ram brand.
Okay, bringing back a known hand. What's the plan for Ram?
It's pretty interesting. First, they're reintroducing the V8 engine option for the Ram pickup.
Whoa, really? Going back to the V8. in this climate.
Sounds counterintuitive, maybe, but they explicitly said up to 40% of the pickup market just won't consider a truck without a V8.
40%. Okay, that explains it. Give the market what it wants.
Exactly. Very pragmatic. They're also targeting the lower end again with a new express truck model, which they'd kind of moved away from.
Covering both ends of the market then.
Right? Plus, boosting production to win back fleet deals, and they've even got the Ram truck back in NASCAR for some brand buzz.
Sounds like a full court press on Ram. They expect better results soon.
They said significantly better Ram results expected in the second half.
Okay, let's switch back to tariffs quickly.
Hey.
That $330 million hit in H1, you said it gets worse.
That's what the CFO indicated, yeah. Since it only covered part of the half, he expects it to potentially double or even more in H2 unless the policies change somehow.
And what about pricing? Can they pass that cost on?
He noted that tariffs are inflationary, but automakers have been hesitant to raise prices because the rules kept changing, and they had older inventory that wasn't subject to the new tariffs.
But that inventory runs out eventually.
Right. So he expects, as that non-tariff stock depletes, you'll start seeing more price increases from various automakers in the second half. That could offset some of the tariff impact for Stellantis.
Interesting dynamic. Okay, Last piece. Liquidity. Cash burn was high. Are they okay financially? They have that target range, right?
Yeah, they target keeping liquidity cash and available credit around 25-30% of their last 12 months' revenue. And despite the H1 cash outflow, they stated they're still well within that range.
So they feel they have enough cushion.
They seem confident, yes. They've also been active managing their debt, issuing new bonds in both the US and Europe during H1 to replace maturing debt, and even issued a little extra while markets were favorable.
Building a war chest.
They literally called it a fortress balance sheet. Designed to handle the ups and downs of this business, they know they're burning cash now, but they need to keep investing.
So the balance sheet is strong enough to weather this storm.
That's the message. And they expect to explain on that July 29th call how and when they'll get back to positive industrial free cash flow.
All right. That sets the stage perfectly for our next segment. Given everything we've unpacked, the tough H1, the big adjustments, the recovery plans, especially for Ram, what's a potential big idea that jumps out?
Okay.
And remember, folks, this is absolutely not financial advice. Just us thinking out loud, connecting the dots from the call, spitballing some outrageous but plausible ideas.
Got the disclaimer loud and clear. Okay. For me, the really compelling thread from this call is that incredibly detailed turnaround plan for the Ram brand.
The V8, the express truck, NASCAR.
Exactly. It's not just vague promises. Bringing back the V8 to specifically target that 40% of the market they admit they were missing, launching the Express for the value end, improving production for fleets.
This sounds very actionable.
It feels like a multi-pronged, very deliberate attack on a super critical, high-profit segment where they explicitly said, we messed up, here's how we fix it.
Okay, so what's the outrageous but plausible trade idea based on that?
All right, here it is. I'm pitching the idea of a long position in Stellantis. Thinking medium term, maybe aiming for late 2025, early 2026. Betting the stock goes up.
Okay, long Stellantis. What's the outrageous part?
The twist is pairing that long with a short position on a pure play EV truck startup.
Betting against an EV-only truck maker.
Specifically, one that doesn't have the safety net of profitable gasoline engine revenue, that's maybe struggling with its own production ramp-up or isn't profitable yet. You're essentially betting against their stock price.
So the thesis is Stellantis' comeback in profitable IC trucks, plus their managed EV transition and strong balance sheet, makes them a better bet than a struggling EV-only competitor.
Precisely. It's betting that Stellantis' clear strategy to claw back share in a segment they know how to make money in provides a more solid, maybe undervalued path to recovery compared to some more speculative, single-focus EV plays.
And the July 29th call could be the trigger.
Could be, if they give positive guidance, and especially if that Ram plan starts showing even early signs of working, that might be the catalyst that gets the market to reevaluate Stellantis.
Interesting angle. A classic turnaround play paired against a potentially overhyped newer entrant.
Outrageous, but plausible, right? Based on what they laid out.
Definitely gives you something to think about.
Yeah.
Okay, so that wraps up our deep dive into Stellantis' H1 2025 preliminary call.
Yep. A challenging first half, no doubt. Net loss, big cash outflow.
But also, impressive transparency from management, some really decisive strategic moves on products, and that detailed recovery plan, particularly for Ram.
The road ahead means launching those new vehicles, fighting for share in Europe and North America, and managing those tariff headwinds.
And all eyes are definitely on that July 29th call with the new CEO for that crucial financial guidance.
It'll be a big one.
As always, please remember, everything we've discussed here is for informational purposes only. It is absolutely not financial advice. Do your own research, your own due diligence.
Always.
So, what stood out most to you from this Stellantis deep dive? We genuinely love to hear your thoughts. Until next time, keep informing yourself.